Hi, my name is Dominic Tamaro, and I'm the Vice Chair for Education in the Department of Medicine at the Alpert Medical School here in Providence, Rhode Island. And today's module in our financial literacy curriculum is on long-term care insurance, part of a series that we're doing on different types of insurance.
Hi, my name is Joe Imparato. I'm the Managing Director at Tucker & Shepley Benefits and Insurance, and I've been dealing with long-term care for over 20 years.
Joe, today's topic is something that I think doesn't get discussed a lot because our demographic, the people that we're trying to communicate with here, is really people at the early stages of their careers. And what we're talking about today is long-term care insurance, which doesn't really come into play until much later in life. So I think it's really good that we're talking about this now, because now is the time when people should be thinking about it. So understanding that theme of long-term care insurance, can you maybe set the stage for us?
With long-term care insurance, it's about protecting your assets when you kind of get down to it. So as you get to retirement age, you're now starting to be concerned with preservation of your wealth and making sure you have enough money that you don't outlive your money. One of the things as we age is we start needing more help. We age, some people have issues with chronic things such as osteoporosis or arthritis, and that just slows you down. But also there are more chronic things like diabetes that really may take a toll on your body and may make you need care beyond just what you can do for yourself. And that's what long-term care is all about. It's meant to that if you have those kinds of issues that you may need help with getting in and out of a chair, making a meal for yourself, long-term care insurance will allow you the money to bring in that care, maybe to your home, or if it's more serious, to go to a facility like an assisted living facility and have people assist you with that care.
Okay, and that will be paid out of the long-term care insurance policy as opposed to using the money that you had allocated for retirement.
Correct. And that's the whole idea is when you get out to retirement, you would like to leave your assets in place for as long as possible. And should you need it sooner than later, long-term care is there to use the insurance company's money to take and pay for someone to come into your home to maybe help you get dressed in the morning, or make a meal, or clean your place. The idea is, again, to leave your assets to grow as fully as possible. So when you're out there and you're starting to take your distributions, you're using as much of your money as possible for that. Many insurance products are pretty easy to understand. Like with life insurance, you pay a premium, and when you pass away, your beneficiary gets a sum of money. With long-term care, it's a little more complicated in the sense that there are things called activities of daily living. And that's how you trigger getting your money from the policy. Life insurance, you die. This one here, you have to be unable to do certain things, these activities of daily living. And those activities are bathing, dressing, eating, getting in and out of a chair, getting on and off a toilet, incontinence. And a completely separate trigger would be cognitive impairment. So when you're unable to do so many of those things, that's a trigger. So these ADLs trigger your benefits. And once you've triggered your benefits, then you start getting money to bring care, again, into your home, or be it in a facility to get that care to help you through your day.
And let me ask you a question, could you comment on who home care givers are? Because what I've read is that many times the care of someone at home falls to an adult child, usually a female adult child. And so that would the long-term care insurance be able to, because that person now is in the home taking care of their parent instead of being out in the workforce or being with their family. Will long-term care insurance pay that person as well for the care that they're giving in the home?
It depends upon the company and the policy. There's basically two types of care. One is formal care. That's going to a health agency, and you're hiring a certified person to help take care of you, and it gets billed through that agency. The informal care is, again, someone in your family, like you said, daughter, son, relative. They come in and they do things for you. Informal care. Not all policies will pay informal caregivers. Some will. So it depends on the contract.
Got it. Okay. So Joe, this sounds like a pretty common scenario. Can you give me a sense for how many people need long-term care?
If an American today turns age 65, there's more than a 50% chance that they're going to need some kind of care. That care could be very basic, and as I may have mentioned, things such as getting out of a chair, making your meal, getting clothes on properly that you're taken care of for the day. So those are very easy things that can be taken care of within your home. But as we age, things may get more complex, again, with more chronic issues. At that point, you're now going to get care maybe in a facility because the needs are constant. So when you're at home, care at that point is probably in the range of about $50 an hour for so many hours a day. But when you start to look at facilities, that cost can easily hit $5,000 a month to up to $20,000 a month. And that would be going kind of from assisted living to nursing homes to memory care units, depending on that level of need.
Okay. So it is pretty common. More than 50% of people over 65 will need something within that range, or maybe multiple points in that range of care.
Correct.
Okay.
And quite often, a lot of times people will start low, and that's maybe where there is. And that's a lot of times where you find informal caregivers assisting children of the family, or maybe a relative. They're taking care of the little things in life. It's when the bigger things and the more need that requires more attention and skill is where you have to start looking towards maybe going to a facility.
Okay. So it sounds like long-term care is a common need as we get older. Can you give some background on how many people have long-term care insurance and what happens if you don't? Where does that money come from? You alluded to this earlier. It comes from whatever savings you've had, but eventually those might run out. Can you give me a little idea of how common it is to have insurance and what happens if you don't?
Right now, in the United States, approximately 7.5 million people have a long-term care policy. It's roughly about 3% of the population. So it's not like this wildly purchased product. Again, it's meant to protect assets. So people that don't have assets or have few assets, they don't need a long-term care policy because should they fall down and need help, they'll get that through the government. There's a Medicaid program. It helps people without assets. So if you don't have a lot of assets, you don't need a long-term care policy. But if you do have assets, you want to protect them. If you don't have a policy, then you're going to have to spend your savings, your retirement plan money, and potentially a house if you own a property. So if you don't have an insurance plan, your plan is it comes out of your assets. And then eventually, if you work it down to a certain point that you don't have assets anymore, then the government can help you.
Okay. And if people are very wealthy, their retirement is overfunded, they might consider not self-insuring, but allocating a portion of their assets for that purpose.
Yeah, and that's a viable consideration when you do have that, like you said, that kind of excess money. You know it's self-insuring is definitely a way of looking at taking care of that issue. I think what happens though is a lot of people are very surprised at the cost of care and how to get that care. And when it comes time to actually write that check for that, even if you have money, it's an issue writing
Sure.
that check, because now you're seeing money that you've worked your whole life for. Maybe it's $10,000 a month. Writing a $10,000 a month check is a big deal for a lot of people.
Sure. And it sounds like there's a big group in the middle that would not have enough assets to cover it, who might benefit from it. We've talked a little bit about the background. I think the viewers now understand what long-term care insurance is. Can you explain kind of the timing? When is this something, you buy car insurance when you buy a car, but this is an insurance policy that is for something that's still abstract in the future. When should people buy these policies if they choose to do so? And could you outline some of the specs or the parts of the policy?
Sure. And you're right that probably the best time to consider buying a long-term care insurance policy is when you least want to think about it. You're probably in the middle of your career, so you're growing in your career, you're putting away money. Maybe you have children, so now you're focusing on tuitions for college and trying to put more money away for a 401k. That's the time when you should be starting to consider long-term care, or at least get it in your mindset, because what happens is as you kind of get over that hump, the cost of the insurance gets more expensive and the ability to get it gets harder, because you have to have good health in order to get long-term care.
Okay.
So a lot of people will start to consider it when they kind of get into their 50s. And again, if you're a healthy person, good, height, weight, you don't smoke, it's not that hard to get a policy, but it's kind of like people will start thinking about it when they see a relative. Maybe they had an issue with diabetes and then they see how more care is needed. That's when they start to get focused on it. So again, it's good to do it in those earlier ages, because the earlier you do it, the lower the cost is going to be.
I see. And so what are some of the different aspects of the policy that someone going through this process should think about?
There's really three main things that people have to think about. The first is going to be, how much benefit do I want? Second one is, how long do I want it to run? And the third one is an inflation rider to help the policy, because it is long. It's a long view of insurance. You might buy something today that you may not use for 10 or 20 years. So a lot of people like to purchase an inflation rider that helps the policy keep pace with inflation over that time period.
Okay.
So with how much, it's how much money do I want the insurance company to give me to pay for care? That could be on a monthly basis or an annual basis. And most people will have a rough idea of how much they want. And the cost of it is pretty simple. The more you want, the more it's going to cost. Okay. The how long is, you can get policies that might last 2 years. You can have policies that are unlimited. They'll pay until you die. And it's the same concept. The longer you go, the more it's going to cost you in premium. So somewhere in there, you want to do some kind of an analysis of how much of this do I truly need to buy, and how much of my assets maybe can I think about using, or my Social Security check to offset the cost of purchasing more insurance. You might purchase less and consider using Social Security as that component.
Okay. And just, you made me think of if someone goes into a nursing home as a that's where they're going to live. They need enough care that's where they're going to live. How long do people usually stay in these facilities? Because that would probably factor into someone's decision about how long a term to get the policy for.
Right, and a lot of people turn around and just look at their own genealogy. They look at their relatives. You'll always hear someone say, "I had an aunt who was in a facility for 30 years." So that's their frame of reference. But there's kind of two statistics that I always like to use with people, and that is kind of from the day that you think you're going to need care to maybe the point that you're done needing care, and maybe you pass on. It's approximately 5 years, but a lot of that could be very little things. It could be just getting dressed in the morning, or having breakfast brought to the table, or getting some supervision while you're showering, okay? Those are little things, and you may not even use a policy for that. But when it kind of comes to the point where someone actually needs some real assistance, it's usually about two to 3 years that it's pretty deep. Because at that point, one or two things are going to happen. You're either going to get better, or, I hate to say it, you pass on.
Is it true that the need for long-term care is greater for women than for men? I mean, since women outlive men on average.
Correct. There is a need. And quite often people will think that that reason is because they live longer, which is true. And it is partially correct. But traditionally and anecdotally, men get sick first. That's the key. So when men get sick first, quite often, the spouse will take care of the man. Men will then die soon. Okay, so they pass on. And the big thing that happens when the male passes is that lady's circle of care, her circle of resources has just shrunk. It may have shrunk because of loss of income, assets, but it also shrunk because he's not there to assist her like she has assisted him. So in a way, women are like long-term care policies for men because they help keep men out of facilities. So again, what happens is her resources and circle of care has shrunk. Now when she needs care, maybe kids can help, maybe they can't, but quite often when you go to a long-term care facility, assisted living, or a nursing home, you'll quite often see more women than men. And that's because women took care of men and kept them out of the facility.
I see, that makes sense.
Yeah.
So Joe, I've heard that over the last 10, 20 years, the standalone long-term care policies have been not replaced, but an alternative policy is called a hybrid policy, which combines life insurance and long-term care. Can you comment on those?
Yes, and this is not relative, it's been around for a while, but it is new to the long-term care field. And that is, you can attach a rider to a policy, to a life insurance policy. And the most common one that we see is what they call a linked benefit life insurance policy. And how that works is it's typically a lump sum payment, one-time payment, or maybe it's a limited term payment, but a lump sum payment of money that, sometimes it gets up to 5 times that value as a long-term care benefit. So if you had a 55-year-old male who was in good health and they put $100,000 down, they would be entitled to more than about $525,000 of long-term care benefit. Okay, and if they didn't need the long-term care portion of it, and they just passed away, then they'd have about $175,000 in life insurance benefits that would go to their beneficiaries. So it's kind of it's a payout either way. It's not a use it or lose it, because like with traditional long-term care insurance, if you don't use it, it's gone. That's all there is. But with this, you may get it as a long-term care benefit, you may get it as a life insurance benefit. So that's attractive. And again, that's more for folks that would have some assets that would be able to do such a level of funding that it could be a good option.
Okay, that's very helpful. That sounds like it may be a good option for some folks.
It definitely is an option, especially if there's some excess money around. And I think a big key is also having a need for life insurance really makes it very attractive, because if that exists, then it becomes a very attractive option.
Okay. Joe, I know that over the last 10 years, long-term care policies that had been taken out by individuals that were already in existence have seen big rate increases in their premiums. Should someone looking at long-term care policies now be worried about this a big rise in premiums over time?
It's true. About the last 10 years, there's been significant increases in long-term care premiums, which 20 years ago weren't expected. And but those increases were due to the insurance carriers' miscalculations on assumptions, interest rate assumptions on the reserves, or how many people were going to drop their policy before age 65. And those errors, even though they may be small, have a big impact to how long-term care works. So with that, they had to go to insurance regulators, the commissioners of insurance, and say, we've got this issue, we're going to be insolvent if we don't get relief. So they have reviewed it, they've justified it, and the insurance commissioners approved these rate increases. And they were significant for some carriers. That has all pretty much been phased in at this point. But what it also made the insurance carriers do was to recalculate these assumptions and all their assumptions to make sure something like this didn't happen again. So today, insurance premiums are higher, they're more reflective of the risk, and insurance companies feel very comfortable with these rates, and they're still competitive, but they seem to be on the track to be much more stable. So would I say someone should be worried about this? I wouldn't say so much to be worried about it, but to be aware of it, that, risk changes over time, and insurance companies like auto insurance, a lot of our insurance every year increase their rates.
Homeowners, absolutely.
Yeah. So it's just to be cognizant that, yes, it may be a flat rate for a period of time, but there may come a time that there could be some rate increases. I don't have a crystal ball to say if it will or not, but being aware of it is probably the biggest thing.
It was really, really helpful about a topic that is at the same time important and I think under-recognized. And so I think this does a really good service.
Great.
Thank you.
Great, thank you.